It's time for the Phil Ferguson Show.
Howdy, this is Phil Ferguson, and you are listening to The Phil Ferguson Show. Today we've kind of got a grab bag of emails and thoughts and ideas, in part because the last episode was all musical, so we didn't do any money last time, so I guess I got to do a little catching up. Get quite a few emails, and I've picked some topics from some random emails that I'd like to go over, so we're just going to jump right into it. One of the questions is, how much does one need for retirement? And the person was saying that I don't normally clearly define this, or I don't do it often enough, or at least I haven't done it recently enough. So one of the really simple ways to think about this is you need at least 20 times the amount of money you want to pull out per year. So if you can safely pull out 5%, you need 20 times that amount, or 100%. So if you want to be able to take $50,000 a year out of your retirement portfolio, you need at least $1 million. If you have more money than 20 times, that's even better. So if you have $2 million and you want to take out $50,000 a year, which is only 2.5%, that's way more safer. Way more safer? Better? Way better? Way more better? Anyway, you get the idea. So the question, of course, is how does one get there? And, a good rule of thumb is that maybe 10 to 12 years out, you should have at least half that amount of money, because hopefully the market goes up. Hopefully you keep saving 10 or 20% of your pay each year, and you can kind of glide into it. So there's some basic benchmarks of what you should save. The other question was, how much do you need to save per year? Again, I'm going to go way back to the suck-ass minimum, which is 10%, is generally thrown around in the industry. And that will work if you start at the age of 22 and save and invest 10% per year for the next 40 years until you're 62. That's probably going to work. The only reason that might not work is that if in the last 5 or 10 years of your working career, you keep experiencing large pay increases that you then get used to. Because if your income and expenses keep going up, it's hard for the investments to keep up and get ahead of you. But saving 10% per year will work if you start when you're 22 or 25 and you retire at 65 or 70. But for most people, you don't save much when you're 22 or 25 or 28. I know I didn't. And it's hard to. You've just got your first job. You've got bills to pay. You may have college to pay. And then you get kids. And you get expenses. It's really challenging. But if you can do it, great. Most people don't think about what's going to happen when they're 60, when they're 22. So most people start when they're 30 or 35, and then you're going to need to save 20% per year. So my general rule of thumb is 20% or more per year. So if you make $100,000 gross, you should find a way to save $20,000 a year. Real simple. If you get to the point where you're 50 and older, and you want to retire in 15 years at 65 or 17 years at 67, 20% may not cut it. You may need to do 25 or 30 or 40%. So it just depends on what you want to do. Of course, you can get a little bit of money from Social Security. If you happen to have a job that has a pension, that helps. And so your nest egg won't have to be as big. So that's kind of some reference points for that question. Another thing was, how do I take money out? And I think I've covered this even recently, so I'm going to keep this kind of brief here. But one of the strategies I use is having a lot of different types of index funds. And again, one of the reasons I like Vanguard index funds is because I can very carefully cut out different types of investments. Like I can buy short-term U.S. Treasuries. I can, in an index fund, I can buy long-term U.S. Treasuries, which I currently do not recommend because of interest rates. But you can buy those. You can buy small cap value. You can buy mid cap growth. You can buy emerging markets. You can buy Ginnie Mae bonds. You can buy high yield junk bonds. And so by having all these different types of investments, you have diversification. Some years, some investments go up a lot, and some years, some investments don't go up a lot or even go down. As a little bit of a reference, if you are currently in retirement and you have a wide variety of different types of index funds, and of course, this is much harder to do if you just have random funds. So I'm going to assume that you're at least following some of my advice and you're using high quality index funds. Vanguard is, of course, my favorite, but you can get them at other places like Fidelity and Schwab. If you're pulling out money this year, let's say you have that $1 million portfolio and you want $50,000 out. Hopefully your stocks and bonds all generated a nice yield of around 2.2%. So that's about $22,000. So you don't reinvest that money. You have it sent to you, and that's part of how you pay your bills. You can also have in a retirement portfolio something close to an entire year's worth of cash on hand, maybe 30 to 50 grand. If you're pulling out 50 grand, then no matter what happens for a year, if everything goes down, you just pull out the cash. That's really nice to know. Now, the more safer, more conservatively you invest, the less you make in the long run. So we don't want to overdo that. But in the last 12 months, ending June 30th of 2018, because I don't look at this every day and update everything daily, because I don't think you should either. You shouldn't look at this stuff all the time, every day. You will obsess over it and you will get caught up in the emotion of it, which is one of the things I'm trying to take out of it. But most bond funds have done pretty poorly in the last 12 months. The one that is the shining star of the ones that I use is the Total International Bond Fund, which is up 3.16%. Not a huge return, but it's positive, so that's nice. So if you had to sell some bonds, that would be a place to do it. However, why would I sell bonds and eat into my cushion when we have the stock market has made so much money in the last 12 months, again, ending June 30th of 2018? And so I look at all the different investments, and I'm very excited about small cap growth. And of course, in the United States, I break it up into 6 segments: large cap growth and value, mid cap growth and value, small cap growth and value. Well, the small cap growth made 21.5% in 12 months. So that's a really good place to take some money from. The large cap growth made 19.34%. And matter of fact, that position has made 15.5% per year for 5 years. I'm very excited to take money out of that. So I recommend taking money out of the winners. And if you made a whole lot in 1 or 2 segments, you can add to some of the losers or the ones that are underperforming or the ones that aren't doing very well. If your portfolio overall has grown, you could even increase your cushion and your security and increase the amount of money you could take out every year, because let's say your portfolio went from 1 million to 1.2 million. You can reset the 5% that you take out from 50,000 to 60,000 and rebalance your portfolio to do that. So there's some thoughts about how one takes out money. And again, from the same listener, they asked, why don't I ever recommend any calculators or online websites that will calculate, I guess, how much you're going to have, how much you're going to make. And they recommended one called FireCalc. I'm not recommending FireCalc. I'm just going to talk about what I experienced when I went there. You can put in your age and how much you have and how much you think you can add every year. And there's some places where you can get a little more elaborate. But the default assumption is that you're going to put something like 70% of your money in stocks and 30% in bonds, which is not an unreasonable allocation for someone in retirement. And then it kind of makes educated guesses on how long that money will last and when you will run out and what are the odds that you'll run out by a certain number of years. So you could put in, again, using our scenario of $1 million, and that you're going to take out $50,000 a year, and you're currently 62 years of age, and you want to plan for the next 35 years, assuming you're not going to make it past 97. And it will calculate the odds that you're going to go broke, which is kind of cool. And it does it with actual real data, at least as far as how much you've broken down the performance. And in the most simplified version, it takes the total stock market returns and the total bond returns since like 200 years ago. Well, maybe it's only 120 years, maybe since 1900. Oh, I think it was actually 1886 or something like that. So it's a long period of time. And it takes each one of those that hasn't ended before the 35-year time parameter you want to use. So one of the problems is that if you want to put in 35 years as the time frame you want to look at, it won't consider what has happened over the last 25 years because there's not a 35-year time period that the system considers it to be valid to look at. That's a potential weakness because if it looked at data starting 10 years ago, after 10 years it would stop and it would have to make a guesstimate about what reality might be going forward. And that kind of defeats the purpose of this program because it wants to use actual data. So maybe it says there's a 35% chance that you're going to go broke before you get to 97. And so you could think, wow, I need to be more careful or take out less money. And one of the concerns that was expressed is that I have suggested on the show many times that taking out 5% a year for most people is perfectly safe. And I stand by that. And one of the weaknesses of this program that I used is that it assumes that you automatically rebalance everything every year. I don't do that. It assumes that you take out your money proportionately every year. I don't do that. Let me give you an example. You have $1 million. Let's say you have 70% in bond or in stocks and 30% in bonds. It'll use the U.S. total stock market index for the 70%, and it will use bonds for the 30%. First of all, that's completely ignoring international. It's ignoring the fact that you can have a variety of different types of bonds and pick and choose which bonds you're selling from. And it ignores that you can break up the U.S. stock market in different segments like I do, where you can pick and choose from the winners and losers from time to time. And so the program then assumes that when you go to take out your $50,000, assuming you told it you want to take out 5%, that 70% of the money will come from stocks, 30% of the money will come from bonds, and then you rebalance so you again have a 70-30 mix, and then it looks at the data for the next year. That's fine, but it's oversimplistic, I think, because if you have a year like this last year where the stock market has gone up something like 20%, why would you sell some of your bonds? Why would you not skim off the stocks? And then why would you rebalance to put more money into the cushion? Because I don't design the cushion as a percentage of your portfolio. It's designed as a size in dollars, and considering the current rate of dividends and the dividends of stocks to figure out how long it can protect you. So you may have a 20% increase in stocks. So your 700,000 goes to 840,000. Now let's say your bonds stay even at 300,000. If $300,000 in bonds or the cushion was the correct number last year, it's likely to be the correct number this year. It may not be, and you may want to change it for some reason, but without that information, we're going to leave it at 300,000 and not touch that. The stock part went from $700,000 to $840,000. You've gotten all the dividends, and then you sell maybe $30,000 in the stocks. So it went from 700 to 840 minus 30, 810, maybe 800,000. So now your ratio has changed, and the stocks are now a bigger part of your portfolio because your overall portfolio is bigger. And we have not changed the size of the cushion because you don't need a bigger cushion. So if the next year is up, you're going to make even more, contrary to what that program would assume. If the inverse is true, and the bonds all make 2%, and the stock goes down 25%, well, in that year, I would recommend against very, very strongly taking 70% of your money out of the stocks. I would say take nothing out of the stocks. They just went down 25%. That's the worst time to sell a stock, or the market as a whole, or these index funds that I recommend. So you would take all of the 30,000 out of the bonds, and you would try to wait out a few years for the stock market to come back up. So when you can take these little bits of information and use it to your advantage, you're going to do far better than just blanketly taking 70% out of your stock portfolio, or 70% of the amount you withdraw out of your stock portfolio. So I don't like the oversimplified methodology that it has, although it did look pretty cool. I mean, I love graphs, but how valuable is it? I don't know. I don't think it's particularly valuable, so I can't recommend it. But you can go there and play if you want to. Another thing that someone sent me was a story about the difference between U.S. Treasury bonds and U.S. corporate bonds, with the suggestion that this author was saying that there's really no point to use anything but U.S. Treasury bonds, and here's why. Since 1976, U.S. Treasury bonds have made barely less than U.S. corporate bonds. Well, the graph that they provided had this data. It was very nice, all the way back to 1976, but it included two different indices. It included the aggregate U.S. bond market, and it included U.S. Treasuries only. And the performance over the 30, 40, almost 50 years was not very different. So the logic of the author was, why take the risk with corporate bonds when you get about the same return with U.S. Treasuries? I don't think the author made the connection that the aggregate bond index includes U.S. Treasuries. So the aggregate bond index is all kinds of bonds within the U.S., not including high risk or junk bond or high yield, not including housing bonds. So what you're left with is basically government and corporate. And they have short-term, intermediate term, and long-term in those categories. And government bonds make up about 60 to 65, maybe 70% of the aggregate market. The U.S. government has a lot of bonds. Companies issue bonds all the time, but sometimes to raise capital, they issue new shares, which is something they can do. But the government sells bonds. So when you look at the aggregate performance, 2/3 of its performance is tied to the U.S. Treasury bond performance. So comparing those two numbers to each other, you have 100% of the bond market versus 66% of the bond market, which is included within the 100% of the bond market. I would expect them to not look that different. We also have the fact that over the last couple of decades, until the last few years, U.S. government bond rates were falling, getting to their lowest in after 2008, 9, 10, 11, and 12, and now they've started working their way up. During that time frame, the higher quality a bond is, generally the more sensitive it is to interest rates. Junk bond funds aren't as sensitive to interest rate fluctuations because you're getting higher returns because of the risk. And part of the return is lost when some of those risky bonds default. So the question is, do you get a net higher return? One would expect that you do, because if you never got a higher return for taking more risk, no one would take the higher risk. So it kind of makes sense that you should expect, and I think the difference from the website that they sent me was something less than 0.5% difference between U.S. Treasury and the aggregate index, which was 2/3 Treasuries. So if you take out the 2/3 and just look at corporate bonds, the difference is probably greater than 1%. And that may be even more significant in the future, because if interest rates continue to go up, government bonds might be more adversely affected by increasing interest rates. The other thing to consider is that you aren't investing, period, for 30 years. You may invest for 30 years, but from time to time, you may want to add money or take out money. So if you're in retirement, the purpose of having U.S. Treasuries and corporate bonds as two distinctly unique individual investments is that you may get a period of time where one of them loses 1 or 2% and the other category makes 3 or 4%. And so if you're taking money out and the stock market goes down And let's say treasuries are flat and corporate bonds made 4. Well, you take money out of the corporate bonds. You take money out of what made 4%, not 0. And you definitely don't take out of the stocks if they went down 25. 4% return sounds terrible in the long run compared to stocks making 10, but in the short run, making 4% in 1 year if stocks go down 25 suddenly looks genius. So it's all about what you want to do and having that flexibility. And currently in bonds, I generally use, and this is not for someone has 20 or 50 or 100,000, but someone has several hundreds of thousands and they're, within a time frame of retiring 10, 15 years. I use short-term U.S. Treasuries, short-term corporate, Ginnie Mae's, international bonds, emerging market bonds, and high-yield bonds. And those are kind of in order from quality to riskiest. And the really risky ones, like the emerging market bonds and the high-yield junk bonds, not more than 5% of your total portfolio. They're not supposed to be a whole lot, but they're there just in case. You have a year where the stock market is down sharply, the other bonds don't make anything, and suddenly emerging markets make 15%. Well, great. Well, that year you wipe out your emerging market bond fund because you made a killing. And then next year you figure out what you're going to do there. That's the benefit of having these diversified investments that you can pick and choose from, which is why that calculator that I talked about earlier before may not work if you take this strategy into advantage. Pardon me. And this is one of the reasons why I like or dislike target date funds. They're not horrible. And especially if you're 30 or 40 and you're saving money, they're going to work just fine. But if you're in retirement and you want to take money out, having a target date fund, having everything in a 2020 fund or a 2025 fund takes away the ability for you to pick and choose to selling from what's hot. And in the long run, if you add to what's underperforming and take away from what's overperforming in retirement, you will do better than just taking money away from everything. So that's some other thoughts to think about. People who have listened to the show recently know that I've expressed some concerns about large cap growth as a specific category, as a segment of the market, and that you should keep your eye on it and not have too much of your money there. I have had people show me their portfolios where they have more than half of their money in a handful of stocks. We know the names: Apple, Amazon, Facebook, Alphabet, which is Google, Twitter, Microsoft, the really, really big companies that have done really, really well over the last 3, 5, and 10 years. And I have been gradually trimming down the percentage that I recommend to have in that specific segment of the U.S. stock market. It's now down to 30% or less of the U.S. stock market. So if you have 30% of your money in bonds, and this is someone maybe in retirement or close to retirement, 30% of your money in bonds, 20% in international, 5 to 10% in real estate, and then the other 40 to 45 to 50% in the U.S. market in general. Well, if only 28% of that or 30% of that is in large cap growth, you're talking 15% or less of your total portfolio. And even in that large cap growth index fund from Vanguard, not all of it is the stocks that I just mentioned. So you're talking about exposure of 4 to 8% of your portfolio in a handful of really go-go stocks, which I still don't necessarily like, but if we're going to kind of follow the philosophies of investing in the big stocks, we have to do that. But sometimes those stocks do amazingly good and or bad things. Recently, Apple hit $1 trillion. And if that makes you excited and it makes you want to go buy some Apple stock, what the fuck is wrong with you? You should have bought it when it was $1 a share 30-something years ago. Don't buy it now that it's the biggest company ever. I mean, maybe it goes up from here. Maybe it doesn't, but it's not going to be an exciting growth, I don't think, because how can it? It's massive. So the thing that you might want to check for, if you have a basket of stocks or you have some mutual funds, stock mutual funds, check what are the largest holdings in those mutual funds. You can do that at morningstar.com. Or if you have, like a lot of people have, who've sent me their statements from their brokerage firm, a lot of people own a lot of Apple, a lot in dollar amounts, because maybe they had a $100,000 portfolio, they bought $10,000 in Apple, and now they have $50,000 in Apple, and it's 1/3 or 1/2 their portfolio. That's awesome. You won. Don't be greedy. Trim that down. Remember, the general recommendation is no more than 5% of your money in any one stock. I have regular conversations with people that have large portfolios that, if you make 50 or 100,000 a year and you've got a multi-million-dollar portfolio, it's hard to adjust your mental processes to thinking about this, let's say, $2 million portfolio. Because if the market drops 10% on a $2 million portfolio, you can very quickly lose $200,000. Well, if you make 100 and you lose 200,000 in a year, that can rattle around and fuck with your thinking. That's why you've got to try to do this from a rational perspective. And you want to diversify. And you want to make sure that if you're close to retirement, you have the right amount in bonds in the cushion. And we'll get to that a little bit after this. But I was just thinking about these large stocks and about Apple hitting $1 trillion. And today, I happen to be going through some old totes in the basement, trying to see what I can continue to throw away. And I came across this binder. And I was like, what is this binder? I opened this binder up, and it has documents from the 90s and from 2000 and even up to 2008 of my dad doing research on stocks. Oh, wow, this is fascinating. I haven't seen this kind of stuff for a long, long time. So I was flipping through it, and I found this sheet of paper, and I'm going to talk to you about this sheet of paper. It has to do with Cisco Systems, Cisco company. And this is on a official Standard & Poor's stock report document. See, you hear that right there? That's an actual real piece of paper from 2000. It's 18 years old. As a matter of fact, it's from April 1st of 2000. And it shows tons and tons of data and graphs and charts and splits and all this wonderful information about Cisco Systems and its official symbol, CSCO. And this struck me particularly powerfully because I remember in real time, 18 years ago, my dad bought this stock. And it was one of those things that he was just starting to come around to accepting the idea of index funds. And he had more and more of his money in index funds. But he still wanted to play. He still wanted to take a flyer, to buy some in this stock and some in that stock. So he bought 5% of this stock. And this report, at the time, Cisco was trading for about $80 a share. And this is part of the analysis that came on this piece of paper from Standard & Poor's in their review of this stock. And I'm just going to read to you a couple of sentences. So I'm going to quote, "We continue to recommend buying the shares in light of consistent evidence that Cisco's market position continues to strengthen while the networking industry remains highly competitive and consolidation in the industry is likely to continue to produce rivals to Cisco's dominant market share. We believe the company's large installed base, strong technology offerings, and reputation should let it continue to thrive. Cisco has consistently posted solid earning growth and continue to look for growth within the industry at an average of 30 to 50% for the next several years. With the shares recently trading at a PE multiple that is attractive relative to Cisco's long-term growth earnings rate, we recommend purchase." And so the long history, at least for 5 or 8 or 10 years, the Cisco stock has gone up, 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 up like crazy. It's a huge winner. Everybody wants it. My dad wanted some of it. And this report from Standard & Poor's, the Standard & Poor's stock report, shows this graph and all these beautiful numbers and all the money that this company has made. And he bought the stock. I don't know the exact price that he paid, but I know he bought it right after this time period, April of 2000. And the stock was about $80 a share. Now, some of you may know where this is going, but the funny thing is this is the peak or near the peak, near the absolute peak of the dot-com craze. And a company like Cisco was, I mean, it's a big legitimate company, but they were swept up in this craze. And my dad bought the stock, like I said, $80 a share. By October of 2002, just 2 years later, it was trading under $10 a share. So it went from $80 to $10. And one of the most well-respected and trusted organizations out there, Standard & Poor's, in their report from April of 2000, was basically saying, buy, buy, buy. Sure, the PE ratio is crazy high, but they're growing 30 to 50% a year, and it's never going to end. Well, it ended. It ended. And, that was something that obviously my dad lost. Oh, what are we going to say? Like 85, 87%, almost 90% of the money that he put in there. And thankfully, it was only 5% of his portfolio. But I remember this and a couple other stocks that really kind of got in his head. And it was after this point that we switched to almost all index funds. And then I found a report a couple years later where I had started building the template that I used even still today in 2018 to show people how much they have in different parts of investments and stuff. So I just thought this was a very fascinating kind of little throwback to Cisco Systems. Back in 2000, Standard & Poor's said buy at $80, and it went from 80 to 10, and I think today it's probably in the 40s. So if you held it for all 18 years, you would have only lost half of your money. But that is called specific stock risk. And this is why when people talk to me and they have 50 or 30 or even 10% of their money in one specific stock, you have to keep in mind that this kind of thing can happen. I don't know if it's going to happen to any of the big boys today, although we did have Facebook lose something like 20% of its value in a day. I'm not trying to ring the alarm bell and say that the theater is on fire. I'm just saying, be careful. If you have a handful of stocks that have done really, really well, consider pocketing some of that profit. If you have a handful of different stock mutual funds from different companies, but you go build them in Morningstar and you find out that all of them have 20 to 30% of their money in 4 or 5 stocks, maybe you need to diversify better. If you need help with that, you can always email me, phil@polarisfinancialplanning.com. Please confirm that you've got the right email address and that we've talked, at least by email, if not by phone, before you send any documents. I'll help you walk through that. I'll help you see how to look at funds the way that I do. You don't have to hire me. You don't have to pay me anything. It's fine. It's what I do. It's what I've been doing for almost 23 years now. And I know that a small percentage of people that get free information end up hiring me, and that's how I make money. So I don't mind helping the vast majority of people for nothing. Contact me if you have questions. And so that's some information about individual stock risk.
You're listening to The Phil Ferguson Show.
I know I've already covered a lot of investing topics today, but I've got one more that I want to go over. And this one is something that is much more temporal. It's much more relevant to today. This is August of 2018. So if you listen to the show a couple years from now, this is not really relevant to you. Things have probably changed by then. I am taking another small step towards making investments more conservative. So before I get into the details, I want to make perfectly clear, because no matter how delicate I try to put this, I know that listeners, at least some listeners, overreact. I am not saying that if you're 30 years old and you have 100% of your money in stocks, that you should now sell them. I'm not saying that. I didn't say that. I want to make perfectly clear I'm not recommending that. Matter of fact, if you're 15 years or more from retirement, this won't even apply to you at all, and you should have the vast majority of your money in the stock market, simply because that's where money is made in the long run. When you go out 8, 10, 12 years, the stock market wins every time. The stock market after 2000, big, huge drop in the dot-com bubble. By 2007, you'd made all your money back. 2008, the stock market went down 37%, and I rode that into the ground. Well, only down 37%. And within a couple years, we made all the money back, and the market's been up every year for almost 10 years now. We've made a lot of money. Even the Great Depression, 1929, if you stayed invested with all the stocks that are available, because they didn't have index funds then, you made your money all back in 4 or 5 years, mostly because of dividends, which some people exclude in those calculations, which I think is fallacious, but that's another topic. So 5 years or less is pretty risky. You want to have the cushion in place. So 15 years or more from retirement, you should still be virtually all in stock. If you're a little nervous or a little skittish and you want to put 5 or 10% in some kind of bond fund that's going to make next to nothing, 2 or 3%, fine. I'm not going to fight you for it. Whatever. It's your money. Do what you want to do. And I've even had a few clients that express concern and they want 5 or 10 or 15% in bonds, even though they're 40. Fine. No big deal. The drag on your long-term performance is not huge. And you're protecting a little bit in case Trump does something really phenomenally, epically stupid. So I'm talking more about people that are 15 years or less from retirement or in retirement. At the beginning of 2017, I suggested increasing the cushion from my normal 10 to 12 years to 11 to 13. And in January of 18, I added another year. So we've gone from 10 to 12 to 12 to 14. And what that basically means is, again, the cushion is not based on a percentage. It's based on how much money you need out of your portfolio that is not covered by stock and bond dividends. So it is a little bit of an elaborate process, but I think it allows me to have the appropriate amount of security to protect you for a long period of time without dramatically hurting the long-term performance. So you want the short-term safety and you want the long-term performance, assuming that when you retire, you're going to live for a long time. You don't want to go broke, or you don't want to have to start trimming corners 10 or 15 years down the road because your portfolio is shrinking. So it's all this fine balancing act. So what I'm going to do is not really go any bigger from the 12 to 14 year recommendation. But what I am going to recommend is that you get to the destination a little sooner. So let me break this down. Under normal conditions, when I have a 10 to 12 year time frame on the cushion, at retirement, you should have 10 to 12 years of cushion. Whatever that means for you. If you're 5 years from retirement, you should be short 3 to 5 years or 3 to 5 years away from having that cushion fully funded. So 5 years away from retirement, you don't want to have 10 to 12. You want to have 5 to 7 years of the cushion already built. And each year you get closer to retirement, you take a small step towards building the cushion and selling some of your winners and moving it towards the cushion. If the market has a big drop, you might want to stop for a year or two. If the market has a big drop and the cushion is not fully funded, it could result in you working a year or two longer than you thought. So it's always these trade-offs about how much risk do you want to take, how much return do you want to make, how safely do you want to guarantee that you're going to retire at the age that you expected. So what I'm going to recommend now is that if you are 5 years or less from retirement, you should have your cushion 100% funded today. So instead of 5 or 6 or 7 or 8 or 9 years of cushion funded today, if you're 5 years out, you should have the entire 12 to 14 years funded. That's because we've made a lot of money for 10 years in a row. It's been amazing. Let's lock in some of those gains. Now, the reason this doesn't apply to someone who's 30 is because you're not going to only invest for 5 years or 10 years or 15 years or 20 years. If you're 40 and your life expectancy is 85, you're going to invest for 45 years. And you're not going to take any money out for 20 plus years. You don't need the safety. But if you're 5 years from retirement or less, I am now going to say you should have your cushion 100% funded. Now, this is something I decided about 2 months ago, and I had to delay making this big announcement on the show because I thought it was appropriate that the clients of Polaris Financial Planning, the people who are actually paying me, get this information first. And so this has kind of resulted from some of the stuff, caused some of the stuff I talked about earlier in this show about having capital gains and paying the taxes and taking your lumps because you made a ton of money. That's kind of why it was kind of more relevant to me, because I've had more clients that are close to retirement that have bigger portfolios where we've been selling some things and trying to figure out how much to sell and when and what are the taxes going to be, working with your CPA or tax expert. So again, to be clear, I am not saying that the sky is falling. I am not saying get out of stocks. And depending on the size of your cushion, based on your personal needs, and this is based on what your budget in retirement is going to be, which can be very hard to figure out, but you're going to need to do it. How much your budget can change. So if you can live on $100,000 a year, just to pick a round number, but if the economy gets bad or the market falls, you can trim down to 60 or 70,000 for a couple of years. You can take more risk because you don't have to have the 100,000. If you need 100,000 to live on per year, and you and your spouse both have Social Security, and you have a pension, and you only need 30 or 40,000 out of your portfolio, then you can take less risk also. So it really depends on you. And the cushion might be, if people always ask me they want percentages, it might be 25% of your total portfolio in retirement. That would be considered quite aggressive. Some people it's smaller. Some people it's 30%. Some people it's 40%. 50% in the cushion, in my opinion, is very, very conservative. It might not be right for you, but somewhere in that mix, with 30 to 40 being kind of the central area for what most people should look at. But you have extreme examples. My dad, at the time of his death, at the age of 81, long in retirement, had 90% of all of his investments in stocks. Actually, almost all of it in stock index funds, because by that point in time, I was helping him do it. And he had enough pension money and Social Security money, and my mom was getting Social Security money, and they still lived way below their means. I actually recommended that they spend more money, but they lived way below their means, and if the stock market fell, they could actually take zero out of the stock market, tighten their belts, and live on Social Security and all their pensions. Well, that's great for them. They can take a lot of risk. That may not be the situation for you. If you don't know how big your cushion should be, again, we can set up a time to talk about it. I can give you some pointers. If you have at least $500,000 portfolio, you could consider hiring me. I would consider letting you. If you have less than that, we'll just have a little talk, and hopefully that helps you go in the right direction. So just wanted to point that out. 15 years or more from retirement, you should be mostly, if not all, in stocks. 15 years or less from retirement, think about getting the cushion a little further along than what I've recommended before. So if you're 10 years out from retirement, you might want to have 2 to 4 to 5 years of cushion in place. And each year that goes along, until my opinion changes, you adjust and increase your cushion. If you're 5 years or less, your cushion should be 100% in place. Pocket some of the money that you've made over the last decade. You've done great. If anyone is listening to this that is a client and says, "Hey, Phil, we haven't had that talk yet," please contact me right away. We don't necessarily have to change anything, but maybe we want to, or at least have this discussion. I think all the people that I know, all the clients that I have that are closer to retirement and that have larger portfolios, we've already done this. Most people I've talked to about this, there are some people that if they have all their money in IRAs or Roth IRAs, I may not have contacted you, and I just made the adjustments because that's what you're paying me to do. It's when someone has a lot of money in taxable accounts that I have to be much more delicate, because I really don't like people getting a surprise $20,000 or $30,000 or $40,000 tax bill. That can be very upsetting for people. So it's something that we go over in advance. We talk about it. We exchange emails, and I want to have a little written record for my file that you knew that you might have a $20,000 or $30,000 tax bill. But we're doing it to protect some of the incredible money we've made for a decade. So that's my thoughts on that. If this whole thing has confused the fuck out of you, send me an email, phil@polarisfinancialplanning.com. We can set up a time to talk, and we're going to have a little break, and then we're going to go into our interview.
My mum only lied to me about one thing. She said there was a God, and but that's because when you're a working class mum, Jesus is like an unpaid babysitter. Do you know what I mean? It's just sort of like, she wants you to be good. You know, the best of working class mum where I grew up she wasn't hoping I'd be a doctor or a lawyer. She hoped I wouldn't be stabbed to death in a barroom fight, you know. So the best thing to do is, well, if he's God-fearing, then he'd be good. It's a good rule of thumb because, you know, I went to Sunday school from about the age of 4 till 8. There was just great teachings of Jesus. I love Jesus. He was my superhero. He really was. God was magic, right? But Jesus was just a man. And what I loved about Jesus was he was kind. And he was brave, and I thought he was amazing. And I thought he was brilliant, like just a brilliant guy, you know. So I was about 8, and my brother must have been 19. He came in once, and I was doing something from the Bible, and I said, "What are you doing?" I said, "Oh, drawing Jesus." And he went, "Who was Jesus?" I said, "Well, he was the Son of God." He went, "Why do you believe in God?" Right? And my mum went, "Bob, shut up." And I knew she had something to hide. And he was telling the truth. And I knew from body language. And then I worked it out, and I was an atheist in an hour.
In an hour?
Yeah. You're listening to The Phil Ferguson Show.
All right, everybody, welcome back. This is Phil Ferguson, and you are still listening to the cleverly titled The Phil Ferguson Show. Today, I am very honored to have an actual living student, someone who's joined the Secular Student Alliance. You may have heard about the matching that we are doing. We might talk about that a little bit, and I probably will mention it at the end of the show. But with me today is Raghen Lucy. How are you?
I'm doing great. How are you?
I am fantastic. I appreciate you taking time out of your busy day to come and join us on the Phil Ferguson Show.
Well, thank you for having me. It's a pleasure.
Now, you are, of course, a member of the SSA, right? What school do you go to?
I attend Minnesota State University, Mankato.
Mankato. Well, I don't know where that is. Wait, is that way up north?
It's way south central, very close to Iowa.
Ah, okay. Yeah, I know some listeners are going to be concerned that Minnesota sounds like a really cold place to go.
Oh, yeah. It's hell on earth, if you know what I mean.
You're not disputing that it's cold then?
No, it's awful. My car barely starts. I can't feel my face when I walk outside 8 months out of the year.
Oh, I was going to say, and that's August.
Yeah, that's middle of June I'm talking about.
Yeah, well, we used to have the joke, you know, places that far north, you know, you get a really nice summer. Both weeks are great.
Mm-hmm. Yeah, I love the one, it's like, there's winter and then there's road construction. Those are the 2 seasons we have.
Yeah, well, Chicago kind of has that too, so that's not too different. But just for laughs, right. How cold does it get where you're going to school?
Oh my God. I think I have experienced negative 40 wind chill.
Now, see, I'll play a trick, and I'm sure you'll get it. Is that Fahrenheit or Celsius?
It's Fahrenheit.
Okay, it's the same, by the way.
What do you mean?
Minus 40 Fahrenheit is minus 40 Celsius.
This can't be true. You're playing tricks on me.
No, I was playing a game because I figured you would know that. But minus 40, I thought that's why you said minus 40, because minus 40 is where those two scales intersect.
Oh, no way. Well, you taught me something.
So I'm assuming you're not a physics or chemistry major.
No, I'm not. I'm a philosophy major. I'm way far from that.
Well, I feel better now, because if you were like a third-year chemistry major and you didn't know that, we might have to talk about your university some.
Nope, I have no fear of disappointing anybody with that.
So you're studying philosophy. Is there specifics to philosophy, or are you just philosophy major?
Yeah, actually, my full major is philosophy, political science, and economics. And I got into that because when I first started getting into atheism, I really got into Christopher Hitchens super heavy. And I was like, well, where did he go to school? And he went to Oxford and majored in that. And I was like, well, there's no way in hell I'm going to Oxford. So I just found a university close to me that had it, and Mankato did. But philosophy is actually my emphasis. There's no specific area that I'm going into. I just picked it because I'm planning on going to law school, and it looks good on a application.
Yeah, very nice. Did you ever get to meet Christopher Hitchens?
I didn't, and that's one of my biggest regrets in life. I wish I got into atheism and secularism sooner. I can't even remember what year he died. 2011?
I don't know the year. It's been a few years. I did have the luxury to meet him a couple of times.
Did you?
Yeah, and it was funny because I had a weird thought in my head when you said it's your biggest regret. I'm kind of thinking that I hope at some point in your life you have bigger regrets than that. But that may sound bad. I don't know exactly, but yeah, in person he's kind of a jerk. So if that helps any, but
doesn't surprise me.
No, he's a very good writer. He's a very good speaker. Incredible ability to use words, unlike me. Huge vocabulary. But in person, sometimes he's kind of a little bit of a douche. So there you go. There you have it. So, maybe it's best that you didn't meet the hero because you might not be impressed.
Right. I can just watch him on YouTube all day. That's enough for me.
Yeah, that is definitely fun to watch. So you're going to school, you're studying philosophy, and how did you hear about SSA and what's your group like?
Well, when I first got to my campus, I found myself in a situation where there were 20-plus religious organizations from Methodist to Catholic to Lutheran and Islam. I mean, plenty of religious organizations and nothing for non-believers like me, which really pissed me off because I come from conservative, deep red North Dakota, and I figured going to Minnesota, it'd be a little more accepted, a little more well-established, and it wasn't. And so where did I meet these guys? Oh, I went to a lecture called Evolution Exposed. How fun does that sound?
Yeah.
Oh yeah, it was interesting. But when you go into a room and you can kind of tell who the atheists are because they're like, this is bullshit in their heads, you know what I mean?
Yeah,
and you can see it. So I found like 3 of those guys and I was like, hey, we got to get something started. I'm pissed. I'm ready to be an activist. I'm ready to do all these things. And they're like, yeah, well, we have no clue how. And actually another podcast that I listened to, The Thinking Atheist with Seth Andrews, he's one of my favorites. So I emailed him, never expecting a reply. And I was just like, please help me, Seth. How do I get something started on my campus? And he said, get a hold of the Secular Student Alliance. They're aces at this stuff. They'll help you out. And so I did. And I love it. My group started off with me and those 2 or 3 other guys. And now we're currently at 43 members. I have a lot of big plans for the upcoming years that I'm in college. I'm a sophomore, so I have plenty of time to get something established, and I'm really excited about it.
Well, out of all that, the first question I must ask you is, did Seth Andrews really say they're aces?
Yes.
Okay.
He said they're clubs.
I'm gonna have to ask him about that. That sounds like a funny thing for him to say. The other thing is that when you said there are 20 religious groups, my first thought is obviously a very small college.
Well, there's like 15,000 students.
Okay.
So it's not too small.
Yeah, my most recent experience is with the University of Illinois, and they have something like 75, 80 religious groups of all kinds, and they have about 45,000, 50,000 students. So 15,000 is not small, though. You're right. That's a pretty good-sized school. But so you started this group, and so what do a bunch of non-believers do in an SSA club? You just sit down and stare at each other and drink beer, or what?
Well, I'm 19, so I don't drink beer at the campus.
Okay,
but
I won't tell anybody. Wink, wink. Okay.
I hope my mom's not listening.
No, she wouldn't.
We have a bunch of meetings. We talk about issues that are important to us. And I'm finding more and more that secular issues are oftentimes human rights issues. So we discuss a lot of like LGBT issues, women's reproductive rights, keeping religion out of government, that type of thing. And in the climate that we're in right now, there's plenty to talk about and plenty to discuss and a long way to go up. You know, we really want to make a difference, but we really have to discuss how we're going to do that first. Another thing that we really like to do is go to the Catholic Newman Center as a group. They have these lectures called Theology on Tap, and we just go quietly, civilly listen, ask questions, and that's a lot of fun because I really enjoy encouraging rational, civil discussion because I think that's an art that's lost in our country. And from that, from going there a couple times, I think we've been there 2 or 3 times, expression of interest in a debate started to float up, as I'm sure you could have guessed. Yeah. I mean, Catholics and atheists getting together, everybody wants to fight, you know?
Yeah.
And so I approached the Newman Center, and I was like, let's get a debate started, and they were totally up for it. So now they're bringing in a guy from California, I think he's from California, named Trent Horn. He's a Catholic apologist and author. And I'm bringing in the one and only Dan Barker from the Freedom from Religion Foundation. We're going to have a debate next fall.
Oh, that's fantastic. Well, do you have a date yet?
Yes, September 24th.
September 24th, and this is, what was the school again?
Minnesota State University, Mankato.
Mankato, Minnesota State, Mankato. And from Davenport, Iowa, how long of a drive would it be?
Oh, you know, I have no idea.
Okay.
I've never been to Iowa.
So it's
I'm
upper,
close, but yet so far.
Yeah, it's upper Midwest. So people that are in Wisconsin, Northern Illinois, Iowa, the Dakotas, if they felt like it, they could all drive 4 to 6 hours and get there and see what sounds like a really cool debate.
Absolutely.
Well, can you...
I think it'll also be live streamed.
Oh, very nice. Yes. And Dan is really good at that, as you know. Mm-hmm. So that sounds like
I lucked
fun.
out.
Well, it's nice that he's coming from Madison because he doesn't have to go that far. But he has done over 100 debates, if I have kept track well enough. So it's not his first time. Mm-hmm. And the students will love him. And of course, you met some people originally when you started the club, and now there's 60 plus members. Are you getting some friends out of all this?
Oh, absolutely. Yeah, and it's really cool because throughout my life, I've had friends that I can talk about this type of thing with because I love learning about religion. I love speaking the truth about being a secular individual and that type of thing, but I haven't had many people coming from North Dakota who can relate to me. And so to be surrounded by people who are like-minded and share the same values as me, that's a really special thing that has come out of the Secular Student Alliance for me. And
so does it provide for you and others a place where you can go and meet and share openly with friends and not feel like you're attacked? Is that fair to say?
Oh, yeah. And our group is not closed off to secular people. I mean, I have a peer of mine who's going to seminary in a couple weeks, I think. And, you know, he wants to be a pastor, and he's part of my group because he wants to come and listen and discuss also. So it's not this exclusive, if you're not an atheist, get the fuck out. You know what I mean? Like, yeah. There's a bunch of us with values that we share, things that we disagree on. We disagree amongst ourselves, and we talk about it. So, yeah, it's really great. That is wonderful. And so Seth suggested you contact the SSA, and that's the Secular Student Alliance, and you contacted them, and what happened? I just want to kind of create a scene in case someone is listening to this that's in a high school or university, and they're thinking, oh, my God, what do I do? What happens after I contact the SSA? Can you walk us through that? Yeah, so I got in contact with a guy named Ryan Bell, and he used to be a campus organizer, and now I feel like he's higher up. I'm not sure what his title is now. My apologies. But they embraced me with open arms. I mean, They laid out some steps. There's a bunch of resources online. The first step really is to become a registered student organization with your university, and sometimes that can be the problem. I did not really come across any roadblocks with my university, but I know that some people down, like I've met people from Georgia, Tennessee, Texas, and when they try to become a registered student organization, the administration of the university will say no. And I mean, for obvious reasons, if you're in the Bible Belt and you want to start an organization full of atheists, like that's going to create some tension and some problems. So I think that's the biggest first step. And then after that, the Secular Student Alliance has so many great staff members who make it really easy, as stress-free as possible. Even though it is a lot of hard work, it is so worth it.
Well, that's fantastic. Now, you mentioned meeting students from the South. Was that at the conference this summer?
Yep, at the conference, and we have a bunch of Facebook groups. We have a Secular Student Alliance Leader Space group on Facebook, and we also have one for the National Leadership Council, which I just became a part of. And so, we connect on social media, but yes, I met a bunch of them in person for the first time at the conference a month ago.
Well, can you tell us a little bit about the conference? Because I'm sure a lot of my listeners don't know much about it. What happens at the conference?
It was easily the best weekend of my life, and I'm not trying to sound cliche.
Yeah.
I try to avoid those as much as possible because I'm trying to be a lawyer, Yeah. But I can't even begin to tell you how incredible it was. There's so many workshops, a bunch of really awesome speakers who are big names in the secular community. There were people from American Atheist, Mandisa from Black Non-Believers was there, and I don't know. The year can get very stressful, trying to organize meetings, trying to organize events, trying to recruit members. But at the conference, it all kind of made sense. You know what I mean? Like there was a click, and there were so many people there who had the same struggles as me. And we just shared a great weekend together, and we didn't even talk about secularism the whole time. I made a bunch of really great friends. It was a lot of fun.
Do you know how many students were there this year?
You know what? I'm not sure, and I'm the type of person who will look at a room of 10 people and say there's 30, so I can't even ballpark that for you.
That's all right. And this must have cost you, at least $1,000 to go down there?
Well, here's the funny story. So I mentioned, I think, that my dad is Catholic, and I don't have my own credit card. It goes through him, and I needed to buy an airline ticket.
Oh.
So I was very stressed about that. Yes, you understand. I have another funny story about him if you want to hear it with this whole debate with Dan Barker thing. But it costed about $800 to get there with staying at the dorms at Ohio State, my airplane ticket, and registration. But SSA covered $400 of it up front. I got a check for $400, paid my dad back. I paid for about $150, and the rest I got one of my friends to help me out and make a donation to me. And so I actually only paid $150 of the $800.
Well, not everyone has the nice friend who will kick in money, but it's nice to know that the SSA helped you out. And I'm asking that specifically because it's one of the services the Secular Student Alliance is able to do when people who listen to my show give money. So once again, it's a bit.ly little bit kind of link, and it's bit.ly/Phil Matches, and it's capital P and capital M. At least I had to put the capitals in there to get it to work. And it sends you to a page on the SSA website, and you can give a certain amount of dollars every month. And it can be $1, it can be $100, it can be $1,000 a month, whatever you want to give. And whatever that amount works up to over a period of a year, me, Phil, and Polaris Financial Planning are going to match $10,000 of it. So if my listeners go and participate and give money, we're going to match that. We're doing this July, August, and September only. So if you're hearing this, you've only got a few weeks to go. So go to that link. I'll put it in the show notes if you didn't make sense what I said, and they can go, and maybe some more students can get some aid. What do you think of that?
Absolutely, and I want to publicly thank you for that because
you're very kind.
That means the world to students like me. That means the world to the SSA staff. The Secular Student Alliance is actually the only national organization who dedicates this much time and these many resources to non-believing students. It's the only one that's nationally claimed. So, you know,
go ahead.
It just means a lot coming from that.
Well,
so
very good. Well, it's one of those things that not everybody can be vocal. Not everyone has free time, and not everyone has money. So if you happen to have free time, you can do volunteer work. If you happen to be in a position in your life that you can be out and open, maybe you do a podcast or a blog or a YouTube channel, or maybe you help someone that already is doing one of those things. And there are some people, and it's very nice for them, that they have money, but often people that have money have other responsibilities and or can't be out in the public. So their best gift is money. And so those are the people that I want to reach out to give that money to the SSA. But you did pique my interest. Tell me about your dad and this debate thing. What's going on there?
Yeah, so the SSA and all of these things have really put a strain on my dad and I's relationship. And it's strange because I used to be involved in pageants. I used to do all this music stuff. I'm a classically trained piano player and singer. And so throughout my life, he and my mom were both very, very proud of me and very supportive, very 100% behind me. But then the atheism stuff kind of started creeping out in high school. And when I got to college, I just kind of went all in with the Secular Student Alliance. And I think it's really hard for my dad to have to distinguish between, I'm proud of you, you're my kid, you're doing big things, making big moves, but I'm also Catholic and you're an atheist. And the moves that you're making is against what I am very attached to. You know what I mean?
Yeah.
So it's a weird thing. We're getting through it. Things are getting a little bit better. But one day I was talking about this, and my laptop is like decorated with SSA stickers that say, I'm an atheist, ask me anything, that type of thing.
Sure.
And something sparked a discussion between me and him. And he was like, you know what? I want you to read this book that I got for free at the church. And he goes and gets it, and he brings it in, and it's called Why We're Catholic by Trent Horn. And I was like, you know what? What a coincidence. I'm bringing in Trent Horn to debate Dan Barker at my campus next fall. And the look on his face, Phil, I'm telling you what, it was a shock to him, but
so is he going
it kind
to
of
the debate?
legitimized what I'm doing.
Yeah. Is he going to the debate?
I don't think so. It's about an 11-hour drive from my hometown to Mankato.
Okay.
And he works kind of around the country. He travels, but
Sure.
I asked him if he wanted to live stream it, and he said he might. So we'll see.
Well, that's very exciting. I mean, they don't have to agree with you, but it'd be nice to have the support. I understand and appreciate that. And even sometimes my kids have done things that I don't necessarily agree with, but as the parent, I try my very best to support them in what they do because they're not going to pick the life that I pick. So I know that can be a bit of a challenge, and I wish you the best with that. And hopefully your good friends in the SSA and friends that aren't in the SSA can be there to help you through that awkwardness. And it sounds like it's not horrible. So you've probably heard stories that are worse, but
oh yeah,
it's never good. And I'm kind of sorry that you have that little bit of hassle, but it sounds like you're doing okay with it.
Mm-hmm.
Now,
yep. I have definitely learned through this whole thing to detach my relationships from my work because I don't want to ruin my relationships and I still want to keep doing my work. So it's kind of a little dichotomy I've got going on.
Yeah.
But it's working for me so far.
Now, I'm assuming then you grew up Catholic. Did you go through confirmation and all that stuff?
I actually didn't because my mom is a Methodist. And this is where things kind of got wobbly when I was forced to go to the Methodist church as a kid. I was like, okay, well, you're Methodist, and I kind of get what that means. But Dad says he's Catholic, and I kind of get what that means. How can you be both? How can you be either? I'm sorry.
Yeah.
And so even at like 10, 11 years old, when I started thinking about this stuff, it confused me a lot. And those questions kind of tormented me throughout my childhood because I am a deep thinker. And I never really bought the whole religion thing. And I never really wanted to go to church. I never wanted to go to sleepaway camp in the summers. I begged my parents not to go. So I never necessarily left religion because I wouldn't concede that I was ever really in it. But my mom won the debate of what church was I going to, and it was the Methodist church, and didn't work out. But
even the soft sell of Methodism was too much for you, huh?
Yeah, it was almost too lukewarm. I was like, what's going on here? Like, everybody's nice to each other, but, like, saying all this crazy stuff. Like, it just didn't make much sense to me.
Have you ever been to a Universalist Unitarian church?
I haven't. I want to now, though. I don't even know what that is, and I'm ready to go.
Yeah, it's a UU church, and the UU church, both the organizations, the Universalists and the Unitarians, came together, kind of share this idea that anybody and everybody gets to go into heaven, and you just got to be nice and be nice to other people. And over the years, it's become less and less and less religion. And matter of fact, most congregations now, they don't have Bibles. They don't talk about God. It's just be nice. And it basically has become humanitarianism. But
wow,
they also have, depending on your location, a very strong woo factor, if you're familiar with the word woo.
Somewhat. Semantic. So explain to me.
Yep. So you'll have people that believe in the healing power of crystals or astrology, homeopathic medicine, and psychics are real. So you can get a lot of people that believe interesting things. They're just not the traditional religious things. They're other things. And so all these people are looking for a home, and this place kind of, in a way, is so open that your brain can fall out and you can still fit in. So it's an interesting place, and sometimes people that come from religion that want to go to a place that has a church-like building and has stained glass windows, and sometimes they have a nice little organ and they have a little choir. You can get all those experiences, but when you talk to individual members, sometimes you have to stop yourself from saying out loud, you believe what? So it's open to everybody. So it can be always very nice and very welcome and very opening. And that makes it a little hard for me because I am not always cool enough to be nice. So I have to be careful if I go to the place. But we've gone a few times. It was one of the places that when my wife left religion, she really missed church. I never missed church. I never liked going, but my wife missed church. And so we went to a UU service because I had been there several times and she had never been. And when it was done, she was like, the singing was great. They had a candle lighting ceremony where you light your candle from the neighbor and the whole room gets lit up from one flame. And they had people read from famous works by famous authors that aren't the Bible, just other books, and different week. It's a different thing. And she just enjoyed it immensely. And I said, okay, well, it's not really my thing, but if that's what you want to do, I'll support you and I'll go with you every week. And she goes, nah, I don't want to go again. And I'm like, but you said you loved it. And she goes, I did love it, but I also just figured out that it had nothing to do with religion per se. So all those feelings I had going to church were all because of the environment and because of the system that was created and the people and the ceremony. It had nothing to do with the fact that there was a deity. And so
absolutely,
it kind of broke the spell for her. And she's like, I don't want to go and just hang out with those people. I'm like, oh, okay.
Yeah. I completely get that. And that's where I think all of these secular communities can kind of come in handy is I don't like religion. In fact, I hate the fact that people believe so many stupid things just because they're told to or because they're afraid of hell. I despise that. I'm very Hitchens-like in that I'm kind of anti-theistic in that way. But I also would concede that we have secularized badly. And we're missing what your wife missed, that sense of community, that sense of having a place to go, that sense of having people to connect with. And that's why with my group personally, instead of going to church on Sundays, I'm planning for us to volunteer on Sundays, have a weekly meal together, get together and hang out and, discuss things that matter to us. It's basically like church, except all the dumb beliefs and the baggage that come with it.
Very nice. I just popped into my head, especially because of Catholicism. At the University of Illinois, every year in the spring, a couple of days before Easter, they would get a table on the main quad, and they would hand out condoms. And the theme for handing out condoms was "Have a Good Friday Night." So it's provocative, and it's a good way for to encourage safe sex and teach people about protecting each other. And it's kind of a little snark on Catholicism in particular, but it was kind of fun. I don't know if you guys want to go
Absolutely.
that far.
Well, I love, what was I just going to bring up? Oh, when people talk about like Catholic missionaries, and that's like one of the biggest things when I'm talking to the Catholic moms, and they say, well, what about all the good work that Catholicism has done? And I'm too respectful to say this, but I'm like, thank you for AIDS and overpopulation in Africa. You know what I mean? Like, thanks for that.
Yeah, we appreciate that.
Like, I love that story, the condom thing, because that's another thing that I really try to do. I used to be an angry atheist. I used to say, you're all stupid and I'm right for these reasons, but now I kind of try to do it with humor and no ignorance.
I like it. So is there anything about your club or starting a group that listeners should know about before we wrap up?
Well, first of all, starting a club is definitely worth it. Not only maybe for your own kind of selfish reasons, my own selfish reasons why I started it, because you want to be a part of something. But if you start a club or you get somebody else to start a club, you can help other people be a part of something. And in turn, that'll help you. And it's just an endless cycle of friendship and making a difference. But the other thing is, if you do find yourself in the middle of the night in your college dorm room or your room, if you're a high schooler, and you're freaking out because you have another meeting to plan or you have another person to call in the morning or whatever, it gets very stressful, but I promise it's worth it. And, excuse me, my alarm's going off. I promise it's worth it. I can't even begin to describe how much the SSA has changed my life for the better. And so it's definitely a worthy project, a worthy cause. And even if you just want to donate to the SSA or see what we're all about, I would definitely encourage you to do so.
Well, Raghen, Lucy, thank you so much for your time and coming on the Phil Ferguson Show. And thank you. I'm delightfully surprised by all your activism. You're making a difference, and I appreciate that you're out there for us.
Well, thank you. Thank you for having me, and thank you for doing the matching donation. It's greatly appreciated, not only by me, but roughly 15,000 people who are part of our organization.
Great. Well, thank you again.
Thank you.
Well, it's that part of the show where we get to wrap things up. I do already have a couple of investing topics for the next show. We're definitely going to talk about Fidelity's brand new zero-cost funds. And unfortunately, I wanted to do some research on that to see what it really means. And I found a website that already did all the work for me. So we're going to talk about stuff in that website and if it's as good as it seems or better than it seems. You'll find out in the next episode. The other thing will be a brief discussion on some crazy ideas that some people in the government have proposed about changing the definition of the word cost, which might dramatically reduce long-term gains and taxes for people that make a lot of their money from stocks. So that's some future ideas. I also, in another episode coming up in probably a few weeks, maybe a month, we're going to talk about long-term care insurance. And I'm not sure exactly how I'm going to handle that, but I think what I'm going to do is kind of rebroadcast the segment I did a couple of years ago, because I have a lot of new listeners who have said, hey, you've never talked about long-term care. Well, I have, and it's not one of those things that changes very rapidly. So I'm going to probably replay that segment from a couple of years ago and then add some additional stuff to it. I also may skip a few weeks up to a month coming up. I'm going to do some traveling. I hate to call it vacationing because I will be working every couple of days from the road. So I will be doing some traveling and trying to find this balance where I get some free time from time to time. And if I get free time, I want to be similar, pretty cool and neat with a view maybe, because Chicago suburbs don't have particularly good views. Everything's flat and everything's the same. So I'm going to do a little experiment, have that. And then after that bit of traveling, I will again be traveling, but kind of sort of for work. I'm going to the CFI convention, SciCon in Las Vegas. That's late October. And then in early November, my wife and I will also be at the FFRF, Freedom from Religion Foundation Conference in San Francisco. So hopefully I can see you at one of those two conventions. I have a couple requests for you, the listener. I'm kind of got this dry spell here where I'm trying to figure out who to interview next. So I'm putting a call out. Who should I interview? It can be someone in politics or political, an activist, someone in investing. Maybe they've written a book that you like that I have never talked about before. It could be someone who's done work on atheism or thought or the mind. I'm kind of open to suggestions. Let me know. It's also helpful if you actually know the person and can give me a link or an email to make my job a little easier. And of course, if there's any topics that you want me to cover on the show that doesn't include an interview of a person, and you just want me to say, look at this type of investment, or is this a scam? Is this good? I'll add it to my list and see if I can get around to it, because what you're seeing might be a little bit different than what I'm seeing or hearing. So feel free to share. Of course, if you have questions about investments, you may contact me via email, phil@polarisfinancialplanning.com. And that's it for this show. Thank you so much for listening. And I appreciate all the people that recommend their friends to listen. And I do hope to see you in person somewhere soon. Until then, ciao.